Welcome to the MLO SAFE Test Study Guide. Welcome. This presentation is designed to help you prepare for the MLO SAFE Test, a key exam for mortgage loan officers. We will walk through the essential topics, tips, and strategies to ensure you're well equipped to pass the exam with confidence. Whether you are new to the industry or looking to brush up on your knowledge, this guide will provide valuable insights and resources to help you succeed. Let's dive into the core concepts and important details of the MLO SAFE Test. In this overview of mortgage loan products, we begin with fixed-rate mortgages. These are the most traditional and stable types of loans, where the interest rate remains constant throughout the loan term. Most common is the 30-year fixed mortgage, but there are also non-traditional options available, like 10, 15, 20, and 25-year fixed loans. These are appealing because of their predictability, as your monthly payment stays the same throughout the life of the loan. Next, we have adjustable-rate mortgages, ARMs. These loans have interest rates that fluctuate based on market conditions. The rate is determined by adding a margin to an index rate, such as the LIBOR. ARMs often have adjustment caps to limit how much the rate can change at each adjustment period and over the life of the loan. For example, a 2/1/6 ARM means the rate can increase by 2% in the first year, 1% in subsequent years, and a maximum of 6% over the entire loan term. Hybrid ARMs are a mix between fixed and adjustable rates. Common types include the 3/1 ARM, where the rate is fixed for the first 3 years before adjusting annually, and the 5/6 ARM, where the rate is fixed for 5 years and then adjusts every 6 months. These loans can be beneficial if you plan to stay in your home for only a few years before moving. For ARMs, there are different payment options. You can have an interest-only payment plan for a certain period, meaning you're only paying the interest and not reducing your loan balance. This could be helpful in the short term but may result in higher payments later on. Some ARMs allow for minimum payments, which can cause negative amortization, where your loan balance actually increases over time. There are also combined payments, where both principal and interest are paid. Lenders are required to notify borrowers at least 45 days before the rate changes. Balloon mortgages are another type, where the borrower makes smaller monthly payments throughout the loan, but a large payment is due at the end, known as a balloon payment. For example, a 361/80 balloon mortgage is amortized over 30 years, but the full balance is due after 15 years. Borrowers must either refinance the loan or pay off the balance in a lump sum when the balloon payment comes due. Reverse mortgages, specifically home equity conversion mortgages, HECM, are a unique product for homeowners aged 62 or older who have a low mortgage balance. These loans don't require monthly payments, but instead, they increase the loan balance over time as the homeowner receives funds. Reverse mortgages require mandatory counseling and come with various costs, such as mortgage insurance premiums, appraisal fees, and servicing fees. The amount you can borrow depends on factors like your age, the equity in your home, and the interest rate. There are several types of reverse mortgages, including the 10-year option, which gives fixed monthly payments for life, and the term option, which provides payments for a set number of years. There's also a line of credit option, where you can access funds as needed, and a combination of the 10-year or term options with a line of credit. A Form 1009 is required for these loans. Home equity loans are another category, which comes in 2 main forms, the fixed-rate home equity loan and the home equity line of credit, HELOC. The fixed-rate home equity loan is a lump sum loan with fixed monthly payments, while a HELOC works like a credit card, offering a revolving line of credit. These loans often come with interest-only payments during the draw period. Blanket mortgages are used for multiple properties or lots, commonly seen in subdivision developments. These loans cover more than one parcel of real estate under a single mortgage agreement. Bridge loans are short-term loans designed to bridge the gap between buying a new home and selling an old one. They are typically used when a buyer needs financing for a new property before their current home sells, and they usually involve interest-only payments. Lastly, construction loans are designed to finance the building or renovation of a home. There are construction-to-permanent loans, which combine both construction and permanent financing into one loan, and takeout loans, which are permanent loans used to pay off the construction loan. Disbursement of construction loans can be handled in different ways: through a fixed disbursement plan, where funds are released at specific stages, a voucher system, where the borrower submits vouchers for payment, or a warrant system, where the lender inspects progress before releasing funds. In summary, there are many different mortgage products available to fit a variety of financial situations and needs. Whether you're looking for a predictable payment structure with a fixed-rate mortgage, the potential flexibility of an ARM, or options like reverse mortgages or construction loans, there's a loan type that can meet your goals. This presentation covers important loan and mortgage terminology that helps both borrowers and lenders understand the key aspects of the lending process. Starting with the 5 Cs of underwriting, which are the core factors used to evaluate a borrower's eligibility for a loan: capacity, capital, credit, collateral, and character. Capacity refers to a borrower's ability to repay the loan, typically assessed by looking at income sources, employment status, and the debt-to-income (DTI) ratio. This helps lenders determine whether the borrower has enough financial stability to handle monthly payments. Capital relates to the borrower's financial assets, including savings, investments, and other liquid assets. It's important because these funds can help cover loan payments and any unexpected expenses during the loan term. Credit focuses on the borrower's credit history and score, which show past repayment behavior and their ability to manage debt. Lenders use credit reports from agencies like Experian, Equifax, and TransUnion to assess this. Collateral is an asset, such as real estate, vehicles, or savings accounts, pledged to secure the loan. If the borrower defaults, the lender can seize the collateral to recover their losses. Character looks at a borrower's reputation and reliability in fulfilling financial obligations. This includes evaluating their employment stability, payment history, and overall financial responsibility. Moving on to disclosure terms, it's important for borrowers to understand the annual percentage rate, APR, which reflects the total cost of borrowing, including both the interest rate and additional fees. The yield spread premium, YSP, is a fee paid by a lender to a broker for securing a higher interest rate. Lender-paid compensation, service release premium, is a fee paid when a loan is sold on the secondary market. When looking at financial terms, negative amortization occurs when payments are not enough to cover the interest, causing the loan balance to increase. On the flip side, positive amortization is when payments reduce the loan balance over time. Fully amortizing loans require regular payments that pay off the loan completely by the end of the term. Partially amortizing loans might require a balloon payment at the end of the term, meaning a large lump sum payment. Bridge financing is a short-term loan used to fill the gap between buying and selling a property. Refinancing cost recapture refers to the time it takes for the savings from refinancing to offset the costs of refinancing. In terms of general terms, wholesale lending occurs when lenders offer loans to brokers at wholesale rates, while retail lending refers to lenders offering loans directly to borrowers. Looking at key players in the mortgage industry, there are various entities involved. Mortgage brokers connect borrowers with lenders, mortgage bankers handle loan origination, underwriting, and funding. Commercial banks provide a range of banking services including mortgages, thrifts, savings and loan associations, specialize in mortgages and deposits, and credit unions are member-owned cooperatives that offer financial services. Regarding price protection options, borrowers can lock in an interest rate with a rate lock, which ensures the rate remains fixed for a defined period. A floating rate, on the other hand, means the interest rate will fluctuate according to market conditions. In real estate contracts, these legally binding agreements define the terms of property transactions, including the purchase price, financing details, contingencies, and closing dates. When a borrower defaults, the foreclosure process begins. There are two types: judicial foreclosure, which occurs through the court system, and non-judicial foreclosure, which follows procedures outlined in the mortgage or deed of trust. Finally, the redemption period is the time after a foreclosure sale during which the former homeowner can reclaim the property by paying off the loan balance, fees, and costs. In summary, understanding the 5 Cs of underwriting and the various terms and processes involved in the mortgage industry is essential for both lenders and borrowers to navigate the home loan process effectively. Congratulations on taking the next step toward becoming a certified mortgage loan officer. We hope this study guide has provided clarity and a solid foundation for your exam preparation. Remember, success comes with dedication and practice. Stay focused, keep reviewing, and you'll be well on your way to passing the MLO SAFE test. Good luck with your studies, and feel free to reach out if you have any further questions or need additional resources. Stay confident, and you've got this.